Capital gain rates feel like the prize, but the IRS doesn't hand them out for everything you sell. The first question is always, is this a capital asset in your hands? If it's tied to your business, like inventory, receivables, or certain things you created, it's often a non-capital asset exam. They love testing this asset category step before you even touch a tax rate. Here are the big non-capital categories to memorize. Inventory and anything held for sale to customers is non-capital, so gains are ordinary. Accounts receivable and notes receivable from the business are also non-capital. And a weird one they love, self-created copyrights and similar works, manuscripts, photos, artistic compositions are non-capital to the creator. So selling your own copyright usually creates ordinary income, not capital gain. Now the Form 4797 Detour. When you sell property used in a trade or business, like depreciable equipment or a rental building, you're generally in Form 4797 territory. Even if the asset is fully depreciated, it's still business property. The exam trick is that business use doesn't automatically mean capital gain. Depending on the facts, part or all of the result can be ordinary, and it starts on Form 4797. Contrast that with personal use property. Your personal car is a capital asset, but losses on personal use property are non-deductible. So if you sell your personal vehicle for less than you paid, that loss just disappears for tax. But if you sell a personal collectible for a gain, that gain is taxable and reported as a capital transaction. The exam loves this mismatch. Personal losses are disallowed, personal gains are taxable. A quick reporting map helps you avoid wrong forms. Most capital assets, stocks, crypto, personal collectibles, and many investment sales go on Form 8949, then net on Schedule D. Business property sales go on Form 4797 first, and for individuals, the results can flow through to Schedule D depending on the type of property and outcome. On the EA exam, if you see used in a trade or business, your eyes should jump to Form 4797. One more exam favorite, the self-created copyright trap. If an author sells a copyright they created, it's a non-capital asset to them, so the gain is ordinary and reported on Form 4797. Meanwhile, if that same author sells a personal vacation home at a loss, that's personal use property, so the loss is non-deductible even though it's a capital asset. The IRS is perfectly happy to tax gains and ignore losses. Avery sells 100 shares of Cedar Ridge Holdings stock for a $500 loss. Almost immediately, she regrets it and wants to repurchase the same number of shares. How long must Avery wait after the sale to avoid the wash sale rules? The choices include 30 days, 31 days, and a year-long wait. Think about it. The answer is 31 days. The wash sale rule looks at a 30-day window after the sale and also 30 days before. If Avery buys substantially identical shares within that 30-day post-sale period, the loss is disallowed currently. A tempting wrong answer is 30 days, but buying on day 30 is still inside the 30-day window. Day 31 gets you out. Ethan and Sophia are married but file separately and don't live together. Ethan sells Hawthorne Company stock for a $4,000 long-term capital loss with no other capital items. 15 days later, Sophia buys Hawthorne stock. On Ethan's separate return, is the loss deductible, limited, or disallowed under wash sale rules? Think about it. The correct answer is that Ethan has a wash sale and cannot deduct the loss currently. Wash sale rules apply when substantially identical stock is acquired within 30 days before or after the lost sale, and acquisitions by a spouse count, even if filing separately. The tempting wrong answer is the $3,000 capital loss limit, but you only get to that limit if the loss is allowed in the first place.